Hi, welcome. Mary Ellen McGonigal here with your weekly Edge show for Saturday, March 5th. Today, I will share with you some of the more impactful news. Of course, the Russia-Ukraine conflict is front and center. There were some other data points that were released that also impacted the market, and I will share that. Also, review of where we closed the week as it relates to the broader markets, and then beyond. We're always on the lookout for potential sector rotation. We did see some of that this week. I'll share that. And then viewer question of the week. And this is all about ways that investors can potentially hedge portfolios by going in defensive stocks. I'll share that with you at the very end. So first up, the news from last week. Fed Chair Powell did come out and talk about his plans to raise interest rates in their mid-March meeting that will be coming up. There was thinking that due to geopolitical tensions that they would put off raising rates. However, it will be lower. We're anticipating 0.25 percentage point increase. And the good news is the reason for that is because Powell and other investors, of course, are seeing that the U.S. economy is continuing to expand. Down here, I do talk about job growth in February. It did pick up substantially. Unemployment now at 3.8%. A pre-pandemic level, so that is in line with an expanding U.S. economy. Of course, Russia unfortunately has pushed further into Ukraine. Lots of impact because of that activity that we'll get into. In particular, we did see commodity, military, as well as defensive areas of the markets rally in an otherwise negative market environment. Technology, internet, and financial stocks all underperformed last week. We'll get into why. And also next week, we do have Consumer Price Index coming up on Friday. This is a gauge of inflation, something that the Federal Reserve is very closely watching, as are investors. From here, let's go ahead and take a look at how the markets fared and where we closed for the week. And here we are looking at a daily price chart of the S&P 500, and we can see another sloppy week, lots in the way of volatility and increased uncertainty in the broader markets. So the S&P 500 did close the week just below this green 10-day simple moving average. Your RSI, that's a relative strength indicator, is remaining in negative territory. Stochastics a lot faster as a momentum indicator is trending upward, but overall the broader markets are in a confirmed downtrend. Each of these moving averages, your 50-day, 21, and 10, are very clearly heading downward. And when the S&P and other indices do have these rally attempts, they are met with resistance at these lower trending moving averages. From here, let's go ahead and take a look at the underlying sectors in the S&P 500. I've gone ahead and added this relative strength indicator, sorted this list in descending order. We're looking at a 2-month daily price chart. Up in the forefront here, we do see the better performing sectors. Down here, your relative underperformers. First up, energy, another big week, up 9.2%. We can see the ascent here, all about oil prices, and we will take a look at that in our next segment. Of course, a lot of this having to do with the Russia-Ukraine conflict, in the sense that Russia's output will be sanctioned and lowering the amount of oil that is in production. Also, utility, healthcare, real estate, and staples stocks up here in the forefront. And these, of course, are defensive areas of the market. They offer higher yields and also have products that are going to be in demand regardless of any economic or geopolitical backdrop. In the lower quartiles here, I did mention that technology underperformed. Internet, that's going to be communication services, and financials really got hit. We'll get further into this in our next segment, but take a look. The group was the worst performer, down 4.8%. One of the primary reasons is we are seeing yields drop rather significantly. Also, implications from the SWIFT, which is the communication services for activity between countries, has been banned, so that Russian activity in that banking universe has been very limited, and in turn will impact select bank stocks that generally do work with them. So also we can see that in that underperforming area, again, just making sure that you're not overweighted, is consumer discretionary. And this is despite a strong rally in Tesla, up 3.5% relative to the markets that were down 1.3% on the S&P. So other than that, consumer discretionary areas did decline, a number of travel related and other areas getting hit with the broader market's deterioration. Let's go ahead and move on and take a look at some of the other underlying industry groups in the broader markets. For my work, I do want to have a very broad sense of various different industry groups, primarily growth related, but otherwise as well. Again, that relative strength indicator sorted in descending order. And I talked about crude oil prices. They did spike up Brent crude to $120, very high. It did close the week at 110. And to give some relevance to that, there was a very lengthy period, I'm going to pull up a weekly price chart here, where energy really hovered around this 65 to 75 range before its recently sharp ascent. Going back, we can take a look at some of these other areas that fared well in that commodity space, and gold, certainly one of the outperformers. Gold stocks were up 7.3%. This is another safe haven area, but also some of these gold miners, they mine other metals that Russia and Ukraine output, and hence there will be a decreased amount of these metals amid high demand. Volatility, I talked about the increase there, and it did close at 32, well above the average going back historically of about 12. This is also known as the fear index, and rising volatility is not good for the broader markets. Let's take a look at some of these underperforming areas. First up, software stocks, so valiantly trying to turn, did get hit into the close for the week, down 3.1%. So a failed downtrend reversal there. Semiconductors also were attempting to reverse, got denied here at this 200-day simple moving average. This group was down almost 6%. So growth stocks back in that deterioration mode. I talked about yields. This is the yield on that 10-year treasury, and we can see how much it has declined over the last 2 weeks. A lot of this is buying of safe haven treasury bonds. In turn, the yield drops. This is not good for bank stocks, who generally benefit in a rising interest rate environment. From here, let's go ahead and talk about defensive stocks that could theoretically outperform during this tough period in the broader markets. And first up is a very large healthcare stock, Pfizer. PFE is the ticker symbol. The company, of course, at the forefront of the COVID vaccine. This gap up here on very heavy volume relating to earnings as well as positive news. The stock did peak in price back here at the end of last year, and subsequent to that has been in a generally downtrending period. Over this past week, however, the stock was able to find support at this 200-day simple moving average. We are beginning to see the stock potentially reverse this downtrend. We're not quite there yet. I'll share with you what we will need to see, but you can certainly put this on your radar. The stock is a 3.3% yielder, currently trading at 11 times last year's earnings after this very sharp deterioration in the price of the stock. And the company did report earnings recently, 142% year-over-year growth, 23% above estimates. But let's take a look at what we'll need to see before turning bullish on PFE. First up, I will want to see the stock at least break up above this 21-day simple moving average, which is at $49. Also, I will want to see this RSI turn positive with a move up above 50. Last up, we are seeing a bullish downtrend reversal signal with this black line up through the red. So that is one good news. And then we want to look at historical precedent as our guide, and we can go back to this August into November declining period. What were the characteristics as this stock reversed the downtrend? First up was that MACD positive signal. And then from there, a break up above each of these moving averages in conjunction with an RSI turning positive. And you can see the significant increase subsequent to that. So put this on your radar. When that RSI turns positive and we break above near-term moving averages, Pfizer could well be on its way. Next up is a consumer staples stock that reported earnings recently as well. This is Hershey Foods, HSY. The company does offer a 1.7% yield, and they did recently report earnings as well, actually the beginning of February. And we can see more recently the stock has been in a nice uptrend. This is that MACD crossover indicating that a near-term uptrend has begun. The stock broke back above these shorter-term moving averages with an upward trending RSI. The company reported very strong numbers and guided higher for this year. They are seeing outpaced demand for their chocolate products, and we can see that the stock is now in a confirmed uptrend. Today's close, we did get a bullish engulfing pattern on this daily bar. In essence, the stock's price did trade below the low of yesterday and closed above the high. So that is the definition for this bullish candle. Look for near-term upside in this consumer staples stock. That's it for this week. Have a safe and wonderful weekend, and I look forward to seeing you here next Saturday. Hey, Mary Ellen here with Simpler Trading. Thanks for watching the video. If you liked what you saw, go ahead and hit that like button and leave comments below. And if you'd like to be notified to future videos, you can hit that bell icon and subscribe. Don't leave without subscribing to my MEM Edge bi-weekly report. I do have a special trial offer. And for those who'd like to learn about trading live with us, you can go ahead to simplertrading.com to learn more.